Wow. All right. We are here. We are joined by Kathryn Rooney Vera, who's the Chief Market Strategist at StoneX Group. A lot of views on bond markets, everything in macro. We can get to currencies and bonds. Kathryn had a very strong call that the Federal Reserve would not hike today. The market thought there was like a 30% chance, or that was at least what was priced into the market. I happen to agree with you, Kathryn. I thought that those odds were far too high, and it appears that you were right. We know that you were right. So congratulations on the good call. I wonder, why do you think the market thought that they were going to hike?
I think there was, there's some historical precedent that a Fed chair that comes in tries to prove his inflation fighting credibility and hike. There's also been some pretty good data in terms of resiliency here in the US. So I think there was a combination of variables, but really 30%. The surprising thing is that, Jack, usually just before a Fed meeting, the market is fully convicted one way or the other. Here it wasn't. 30% is kind of quibbling about whether or not it's going to happen. I talked to a few guys and gals saying 50% odds. But if you look at economists, they were broadly in favor of a hold, which is the category that I also fell in.
What did you make of the meeting? What were your broad conclusions?
It was interesting because the presser he revealed, or Chair Warsh revealed very little. And you and I were talking beforehand. He kind of spoke at odds to his own statements here and there. And in and of itself, that messaging, in my opinion, is telling. He repeated focus on market pricing, implying that he prefers markets to shape the expectations rather than the Fed attempting to lead them, but then said something a little bit different. I think that what we see in the market reaction is also very telling. We saw a sharp rise of the 30-year Treasury yield. I think investors are beginning to wonder if he's going to actually hike. This is a Fed that is fighting credibility issues for many years, many years, 5 and counting, of missing their 2% target, with a lot of tough talk and very little action. So I think the 30-year Treasury yield speaks volumes. You see the 2-year dropping, 30-year moving higher. So you see that steepener. And if the committee doesn't eventually reinforce its rhetoric, Jack, I think that this could be yet another blow to Federal Reserve credibility.
So the long end of the bond market sold off, yields went up. The short end 2-year yields went down. So the market is pricing in fewer hikes, a more dovish policy in the short term. Right. And as a result, the long end is saying, whoa, if the Fed is not going to fight inflation, it doesn't matter how much Kevin Warsh talks. Like, if they don't actually raise rates, why do I own a 30-year Treasury?
That's exactly what happened. And, the markets prior to this meeting were forecasting, very a 90% chance of a rate hike by year end. And now that's been taken back. So yeah, the front end heard not happening, not today, not for the foreseeable future. And the back end heard inflation is going to be above 2% for the foreseeable future. And the Fed is losing inflation fighting credibility. So let's see what happens. I think that I don't think it was a horrible presser. I hear some other pundits saying he did very poorly, but Jack, I don't think that his lack of really divulging much information should come as a surprise. This is a Fed chair that was put in his seat. And in fact, you might have been at the Dean Kernitz's event a few years ago where he spoke, but Kevin Warsh has said repeatedly that his goal is to take an interventionist Fed to a laissez-faire Fed. So once the market stops talking about the Fed, that's where he declares victory. And so he's pulling back the reins on communication. I think we should see more of that next year, after he, indicated that he's going to continue status quo through year end.
So the world that we know so well, Kathryn, the world where the Fed is going to signal what it is going to do and is very open and transparent about how it's perceiving data and its potential reaction function to that data. That world we know so well, Kathryn, honestly, fondly, think of it fondly, no longer exists. That's what you're saying. So in this world where the Fed is not going to tell us any much, the info has been reduced 80 to 90%. What does that mean? You had a piece where you wrote about how to position for a Fed that says less and a curve that says more.
Yes, sir. That's exactly right.
What do we need to know about this new world that we're in broadly, and then specifically investment implications?
Yeah, a quieter Warsh Fed moves the risk premium, as we wrote, John Hilsenrath, my colleague, and I, in our piece on Monday. It moves the risk premium out of the statements, out of the pressers, out of Fed speak, which is what we lived and died with and held our breaths endlessly to hear from the Fed with its forward guidance and its meaningless thought plots. But it moves that risk premium out of the Fed and into this and the statement and into the curve. And that's, I think, what we're seeing. So we should expect less guidance. We're already seeing it. He's not answering directly, questions very directly. But less guidance doesn't mean easier policy. And I think that's what the market is also trying to digest. It means more uncertainty around each meeting. And I'll reiterate something that I think many pundits have talked about, which is the fact that a lot of guys on the trading desks are very young and they haven't really experienced pre-crisis Feds. But we're kind of going back to how things used to be. This is we're out of crisis mode. The Fed doesn't have to be holding the market's hand all the time and guiding it in its decisions and leaking information. So I think that, yes, this means more uncertainty. It doesn't mean monetary policy is going to be erroneous in nature or make a lot of errors. It just means perhaps more rates volatility and potentially higher borrowing costs when the overnight rate is unchanged. And that's not a bad thing, because high rates, they work themselves through the system. So he doesn't necessarily even have to hike rates. Just by holding rates where they're at, we see restrictive financial conditions in mortgages and lending rates and consumer financing. So I think we're on course, a corrective course, and I don't think it's necessarily a bad thing.
What does it mean for the shape of the curve in terms of whether it's going to flatten or steepen?
I think a lot has to do with productivity levels. And this is something that I particularly am keen to hear from the Jackson Hole speech, where Chair Warsh is seeing productivity levels. Because if you get a boom from productivity, effectively from AI, which is what Steve Myron has been talking about and other doves from the Fed have been talking about, that is true. And you can have a boost in productivity that can absorb inflation to an extent where you can grow at a very strong clip without being inflationary, because you have that gentle deflationary pull from advances in productivity. So if we get more widespread adoption of AI, which we haven't seen yet, and I think a lot is bluster at this point, and I think you see that in semiconductors and the tech stocks moving lower in the past few weeks, it's kind of like show me the money. But I think if you can get productivity online and widespread adoption of this, then you can see the markets resume their belief in a Fed that can reach its target. If we don't get a boost in productivity, I think it's going to be a lot tougher of a call for the Fed to hold rates or even cut rates. I suspect that we are going to see some rate hikes this year. I was hoping that my call for the receiving by the end of this year would play out. It didn't. It's not going to, because apparently the call is now on the opposite side. The markets aren't expecting many hikes, but I do think unless and until we get that productivity boost, then you're not going to see the front end moving lower in the foreseeable future.
Okay, so you were a temporary bull on the front end, but now you think it's roughly fairly priced.
Yeah, and also what I tell our clients tactically is, if you like our trading desk, we look at flatteners tactically, so you can put on trades that make sense. But if you're banking on long duration, I wouldn't necessarily go that far. I think that the Fed is going to have to hike, but I doubt that they hike to the extent needed to cap inflation. Let's see. My call, Jack, is that the first hike is going to come post-election. I don't think they do anything in September. I think they go in December. And then if the economy continues at the pace that it's at, which is, yes, a slowdown, but still trend and potentially above the neutral rate, potential growth, then I think more hikes necessarily need to be in the offing for 2027.
Do you think that Kevin Warsh kind of wants the market to price in a lot of hikes so that he doesn't have to deliver them?
Yeah, I was talking with an economist friend, and she said to me, it's a toss-up as to whether or not he hikes today to be able to cut before the midterms. I don't buy that stuff. I think that would be an even more severe mortal wound to Federal Reserve credibility. You do not want to be the entity that goes and then hikes and then a couple months later cuts. I don't think that politics plays a role here. I think if it were to play a role, it would be the opposite. Kevin Warsh would probably hike today. There's arguments on, on both sides for hiking or holding. In my view, it's unlikely that he's going to do it in September. But who knows? We have date out tomorrow. We have date out the next day where we're going to see GDP. We're going to see inflation data to tell us and gear us a little bit more. By our estimates, if you get inflation at 0.2% month on month from here through year end, there's a good chance that he doesn't hike at all. If it moves higher to 0.3 month on month on average from now through year end, you can bank on at least one hike this year.
And what is your outlook on inflation? How does that compare towards other, blue chip estimates and also the Fed's own estimates that we got last month in the dot plot?
Yeah. Well, yeah, June CPI weakened remarkably. Of course, that was because of the retracement in oil prices. And now what we're seeing is a reversal of that trend. So core CPI was flat, shelter rose a small amount. So that was very good. When you look at core PCE, housing is a substantial contributor in attribution points to that overall number, second only to services ex housing. So when you get a deceleration in shelter costs, that's a very welcome signal. So I would like to see that continue. Affordability does remain an issue. And I think that the Fed has played a material role, Jack, in crowding out the private sector in the housing market, rendering it even more unaffordable. So a lot of this is a self-inflicted wound by the same Federal Reserve. But I would like to see inflation on the shelter front move lower. And then on the service sector front, that's where we need to see an improvement. But one soft report doesn't mean a return to 2%. So I think that also gave the chairman some cover to not hike rates this month, and wait to see what tomorrow's data shows. My expectation is that we do miss the 2% target for the next 2 years. I think we probably end this year exactly where the Fed sees it. Actually, that's what we have. And in that scenario, and my base case is for one hike this year. So yeah, I think we're pretty in line with general estimates. Inflation can remain above 3%, for some time. And I think the Fed has been proven to be comfortable with that. Now, I would love to see this chair, meet expectations and fulfill his promises. I think that he has to, and hike rates if we continue to see this trajectory, both of inflation, of oil prices, of food costs, which I think are still in the pipeline to increase because of the closure of the Strait of Hormuz and the impact on fertilizer, and then also because of the robustness and resiliency of the economy.
Yeah, just a side note, Kathryn, I'm paying attention to the price of sulfur. I probably check it like 2 or 3 times a week. The price of sulfur is extremely high, and that does not bode well for fertilizer prices, which does not bode well for food prices. So that is definitely something that I think we should look at with. So Kathryn, you said that you think if we get some 0.2% of inflation every month, then the Fed doesn't need to hike anymore. So I'm just, simple math, 0.2 times 12 months in a year, that's like 2.5%, 2.4, 2.5% annualized inflation. What do you think is Fed Chair Warsh's break-even point, or his breaking point, where he basically has to hike? Otherwise, he's going to worry that his credibility is not being taken seriously. You said that you think inflation can stay above 3%. I mean, yeah. Give us more specifics on this, because it's a question that he seems so unwilling to want to give any guidance at all, but it really is what everything hinges on.
Yeah, we always look at calendar years, right, Jack? But I think we have to look into next year. So this year, no chance of hitting the 2% target. I think he would probably to hit the 2% target next year, which is unlikely. I mean, even in the summary of economic projections, we haven't seen his estimates yet, but unlikely to hit next year either. But like he said, it's you have to take things slowly, and I'll give him the benefit of the doubt as soon as he starts. So if they hike once this year, some guys are calling for 3 hikes. I doubt it. I say 1 to 2 this year, and I expect another 2 next year. I do suspect so. And then there's that transmission time that it takes for those rates to take effect in the economy, which I would argue rates have proven, as high as they have been, to be less efficient a tool to blunt inflation and bring it down as they have been in the past. And a lot of people talk about structural changes. Well, there are structural changes, and you can even see that on the other side of the coin, which is the dual mandate. You have inflation, but you also have the unemployment rate, and the unemployment rate has been so remarkably low. And one has to ask themselves, why is that, and does it have to increase for the Fed to cut rates? If it stays low, if it goes lower, is that inflationary? Does it cause the Fed to hike more? Well, we have to look beyond that. I mean, even if you look at the Fed's own estimates of new entrants and the new neutral to maintain the unemployment rate where it's at, we're in a very different scenario than we were a couple of years ago, even 1 year ago. Even by the Fed's own estimates, new entrants to keep the unemployment rate in neutral is close to zero. So less than 10,000 new non-farm payroll jobs generated per month and
Kathryn, I think the reason you're saying that is because of immigration. Could you just explain why, just for me and our audience as well?
Well, yes, absolutely. Because what we're talking about is labor force participation. So when you have fewer people entering the labor force, as in the case now, we have net zero immigration, then you have a lower participation rate, and you have a lower, in this case, you have an unemployment rate that has remained sustained low for an extended period of time. Why? Because we don't need 150, 200,000 new jobs generated to keep pace with new entrants into the labor force. And that's the immigration wave that you alluded to. And so now we have to grapple with a new situation where the neutral rate of new entrants is no longer 150 to 200, but historically it has been, and it's now about zero. So what does that tell us? Bottom line, not to elongate too much, but bottom line, what does that tell us? As an economist, that tells us that we've seen 36,000, I think, on average, non-farm payrolls for the past 12 months, if I'm not mistaken. Those are the numbers. Guys look at that and they say recession, but you can't look at it the same way anymore. So I'll toot my own horn here, Jack. At the beginning of the year, my outlook, what I said was, the U.S. economy is we're not in stagflation. We're not in recession. We're actually in this two-tier overheating in some segments. And I called it back in January saying, we're going to get cuts in the front end of the year. In the second half of the year, if things stay as they are, of course, I didn't know the Iran war was going to happen. But at that point, what I did say was, in the second half of the year, we could be looking at rate hikes. And I said that repeatedly in January and March. And I think we've been proven correct on that. And I do suspect we're going to get hikes. And I would throw one other idea out there, which is U.S. exceptionalism. I said that would continue to be the case. And in fact, it has been the case. So all we have to see now, kind of like to pull this all into one neat, tidy bow, is what we have to see now is broad breadth adoption of AI automation. Yes, that could mean creative destruction and an increase in said labor market. But that would allow the U.S. economy to grow above potential. It would increase the rate of potential growth for this economy. And we would not have to take rates markedly higher. To get there, though, like I said, we have to have adoption. So we see a lot of CapEx. I know you're on top of this. We're probably going to see additional investment in CapEx after the close today. And that could be even more important than what happened with the Fed. But that I think is the game changer. And if I can add one more point, is that when you look at CapEx investment with the 700 billion plus that's anticipated for this year globally, all of that has helped this economy grow. It's helped us in the private investment. It's net detracted from net exports, but that, in my opinion, is all positive for productivity. So to close, I think we don't have to hike too aggressively. I think productivity rates are good. They haven't even counted on the adoption of AI. I think it's ongoing, and that will allow the U.S. economy to reach a new equilibrium, which this Fed is, I think, anticipating and hoping for.
So you're totally right that there's one part of the economy that is overheating to the extreme. It's red hot. You're going to ruin your hand, burn your skin off if you touch it. And that is the AI semiconductor CapEx space, building out data centers. I mean, these companies are growing their earnings at 40, 50, 60, 160 percentage points in some places. It is ridiculous. And yes, I just did pull up, nominal GDP is now growing year over year at 6%. That's pretty hot. It had troughed its growth at 4.6% of, let's say call 18 months ago. Do you expect that we're going to see that nominal GDP and real GDP go up more than it already has? Because even though it has gone up, and you're totally right, it hasn't gone up nearly as much as just the red hot, burn your hand off semiconductor capex. Like, do you think that eventually there's going to kind of level out and it's going to broaden out? Because just I look at the huge dispersion between AI capex and non-AI capex, and it kind of says some negative things about the non-AI part of the economy, I might say.
You make a very good point, and you're totally right. And this is the segment that's fueled not just a lot of parts of economic growth, especially in the private investment portion, which has been phenomenal and astronomical, but also it's fueled the market. So, we have this, I would say, this vulnerability to this segment that, crossing our fingers, it does pan out. I think it will. And these companies many of them are already profitable. So it's certainly, in my view, not a bubble, but this has to broaden out, because what we're seeing is an economy and a market that's increasingly needs this continued investment. I do think that you could get additional boom from the trade sector. You're seeing a widening trade deficit. So as these imports of capital equipment decelerate after this, arms race to capex investment cools, perhaps, then you could get, in my view, an improvement in the trade balance. So when you look at C plus I plus G plus X minus M, right now consumption is really good, private investment is excellent, government spending is good, net exports are negative. So I think you can get probably an improvement in net exports. How much pulls back from private investment? I think you make a very good point, and I think that in that case we would really need to see rates come a little lower to support the other than tech industry, small businesses, medium-sized businesses, companies that can access lending and can finance their own capex at a lower rate, and thereby perhaps employ more people and grow the economy. So in short, I do think there has to be a broadening out. It's been great so far. We are seeing a deceleration. So 1Q, 2.2% around, 2Q is probably going to come a hint over 1%. I think a deceleration is actually a good thing, because if you see an economy that continues to grow at or above potential at our developed market status, then that is inherently, it's debatable. Some economists say it's not inflationary. I think it is.
You're talking deceleration in real GDP or nominal GDP?
Oh, I'm talking about real GDP right now. Sorry. Yeah. So yeah, I think that's where we stand.
That makes sense. It's what is your concern about AI being a bubble, the capex being too much?
It doesn't seem to me quite a bubble yet, unless and until you get stupid money chasing not stupid money, but too much money chasing unprofitable enterprises. And that's not what we're seeing now. We're seeing profitable enterprises, and we're seeing real investment here. So that, for me, classifies it as something real, because we are seeing profitability. If it were something that was unprofitable, like we saw in the tech boom back in the early 2000s, then I would be more concerned. Where I am more concerned is if we do see rates move higher and you see the tech bubble, well, it's not a bubble, but if you see tech correct, then you get the wealth impact affecting consumer confidence, the US economy, and guys who think they've been diversified because they've gone into small cap or emerging markets or industrials to diversify away from tech are not actually diversified, because there's heavy weightings in tech in all of those sectors. And
don't worry, Kathryn, I'm diversified. I own Korea.
Oh, there you go. Korea, Taiwan, they've all been great. So they're all doing fantastic. But if you get tech, which is a sector most vulnerable, or most rates vulnerable, then I do expect a correction. And actually, we have been calling for a correction for some time, and I think we're seeing it now. One of my points of reference for our client base has been to say, throughout the year, you can see complacency reflected in the volatility index. So when the volatility index, and some technicians don't like using this, but it's a rule of thumb that I like to use. When you see the volatility index break below 15, hit 12, hit 13, that means protection is cheap. So you can buy put spreads, you can buy protection on your portfolio, on your AI and tech portfolio, without having to sell it too dramatically, or without having to rotate out of it. So that's been one of our calls, and it's worked out pretty well. and especially right now. So yeah, I think that's where we need to be positioned. But I guess you were asking about nominal growth, and it has been stellar. I think we can see it recede, but AI has been the most tremendous driver that in my lifetime that I've seen move both the economy and the markets. But I do want to see it more broadly adopted so that it can have those positive economic impacts in the real economy and be that buffer against inflation.
Kathryn, what do you think of commodities, gold, oil, and other commodities?
Yeah, gold has been one of our best calls, and on a retracement, we've been recommending accumulation. It's a hedge against the loss of policy credibility. I continue to think so. I think a genuinely disciplined Fed and sustained rise in real yields could weaken that case. But I like gold. It's been a great performer for us. With regards to oil, I'm in the camp that once we see a cessation of activity in Iran, and that's eventually going to be the case, some economists think it's going to stay high for a very long time. I think it comes back down, and that's going to be a very positive thing for inflation and the pass through to inflation and for the consumer at large. So I do think we will see a close to immediate drop when we get a reopening of the Strait of Hormuz, or just a complete stop of this conflagration, which is really an escalation in what we're seeing. So really, Jack, who knows? Uncertainty is very high on the oil front and on the geopolitical front, but commodities in general, I think you've touched on the two biggest ones. Oil, energy stocks were one of my top picks coming into this year. It's been the top performing sector year to date. So another, we've got some bad calls, we've got some good calls, but that's been one of our good ones. Now from here through year end, I'm more cautious. I'm recommending to our clients some realization of profits on that front.
Okay, so some realization of profits on the energy side. No worries, Kathryn, at all if you have to put this into the too hard pile, as Charlie Munger says. But thoughts on semiconductor stocks, which had been the best performing stocks by far, but over the past 30 days have really been in a little bit of a slump.
I like something you posted, and I haven't checked the prices since then, but I agreed with something you wrote on Twitter, which was, if we get a hold and if we get additional capex investment, we could see boom in the semiconductors, and I tend to agree with that. I think if we don't get rate hikes, if we get additional capex, I think there's additional upside, and this is a real story. There's a lot of hype around it for sure, but I do think there are opportunities, especially under that scenario. So careful. I can't talk about names or anything like that, but I do think that there's strong evidence of AI monetization here.
Well, what a transition, Kathryn. We're going to get into Microsoft and Meta, just about to report earnings. Thank you so much, Kathryn. Tell us where people can find you on X and elsewhere.
Yes, thank you so much, Jack. Such a pleasure to join you. On X, Kathryn Rooney Vera, as well as on LinkedIn. Thanks. A joy to join you today.
Thanks so much, Kathryn.